Well, all good things must come to an end, and Friday's session was filled with tension to the point where you could almost feel it in the air. SMCI was down over 20% on the day, and I'm sure people are starting to question the fate of NVIDIA, who reports earnings on Wednesday after the close. So, is it really all about to end? Is that all she wrote? Let's take a look through the data points and build a logical game plan for the week ahead. As always, check out the links listed down below in the description. Hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 3.5 additional trade ideas to share with you that you won't want to miss. So with that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For candle structure, certainly a hammer style bar with a very long lower wick, very minimal candle body. However, we do still have a red bodied bar here, so the buyers were unable to recapture the opening print technically, and we did close slightly red, but the lower wick is worth reading into and just saying there was a substantial response from the buyers near an equal low. So let's take the bar by bar count, and you can see that we do have about an equal low. If you want to split hairs, it's technically a higher low. And along the way, we did produce a higher high earlier on in the week from the Monday session. So I would really argue that structurally buyers are in control with that long lower wick, maybe not as firmly as obviously all of these preceding green-bodied bars with strong closes, but nonetheless, there was a solid response. And of course, on the bar-to-bar count, we didn't make a lower low. We didn't close at a higher high, but we did produce one. So I would still say that the buyers do have the upper hand there. Now, a lot of folks refer to this as a hanging man candle, and classically they start to acknowledge that yes, there is some downside momentum, the buyers responded, but it means that the trend is slowing down from over here. And I just want to remind you that the trend is certainly up. So even if this is going to represent some slowdown in momentum, we have lows, we have very higher lows. Along the way we had highs, and certainly higher highs last week. Remember, we can afford a pullback here on the weekly time frame chart all the way down towards this 480, 477 zone that we've been talking about for a couple of weeks now. Remember that the 480 is more so aligned with the previous all-time high from back here. So just don't forget your time frame, right? If you're a weekly swing trader, this shouldn't really do anything to shake you out of a position. We're still looking for an opportunity of a weekly higher low to be found over that 480 if it materializes in a stronger pullback. But with the buyers stepping up in the lower wick of the weekly range, I'm not really getting that sense yet on this higher time frame chart. Now, the daily is a different story, and we'll get to that in just a moment. But let's take a look through the lens of some of our tools here. Firstly, Fibonacci's low to high from the October low, still getting the 38.2 here. And once again, as a reminder, the higher low over 480 just means that we would, of course, be above the 38.2. If we come in with the fib from the pullback low in January to the most recent high, notice that the lower wick of last week's bar is still over the 38.2. So is it, can you say anything here that the bears are building an overwhelming edge? I think that the answer continues to be no. And if anything, we're maybe going to be mindful of momentum slowdown, possibility for sideways consolidation, but if anything, really just starts to look more so like a weekly bull flag. As we know, if we bring out the anchored view apps here on the weekly, they're not really in force until we come back closer to that 460. That's the monthly higher low thesis. So we'll move along to our volume profile. And as we know on this one, again, the prior all-time high is a volume shelf, not much to read into over here. If anything, the lower wick of last week's bar supported off of this small protrusion, but again, not going to read into that too much considering it's only got a couple of weeks back to back here at those all-time highs. The last thing we'll do, and this continues to be the case for the ending of the weekly chart on many videos here, is just looking at the Fibonacci extension, reminding ourselves that the 61.8 is confluence with that 480, 477, and the 520 target overhead is within sort of striking distance. It's not a pie in the sky number anymore. Another consecutive 3-4 weeks in the upward direction. Let's say that this turns into a 2-week range. We break out of it next week. Let's say that NVIDIA earnings are blockbuster reads. It's like, oh my goodness, this thing's going, I hate to use the term, to the moon. We could find ourselves at 520 sooner rather than later. So it's not really a stretch at this point. Higher time frames remain in an uptrend. Yes, momentum is slowing down, but there are no immediate indications that everything's about to go to hell in a handbasket. On the daily time frame chart, let's first evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 506.24, implying a higher high, new all-time high. If we're contained by the lower bound, the number's 492.81, implying a very nuanced higher low. So for that reason, expected move is still slightly bullish, but as you can see, it is a lower high from the previous week's expected move, and it's much closer to an equal low here at the lower bound compared to the low that was set on the Tuesday CPI gap down. As we know, the trend still remains in the upward direction with lows, higher lows, higher lows. This was the last firm higher low on the daily time frame chart, and I'm pleased to announce that obviously along the way we had highs, higher highs, higher highs. This is an equal high, so instead of coming up short and really producing a lower high, threatening a lower high double top, we now have an equal high, leaving the door open for two possible outcomes for trend continuation. Number one, the simplest, is just straight up producing a higher high, breaking out through the equal highs here at 503. That would be a new all-time high. That is trend continuation point one. Trend continuation point two is finding another daily higher low because we're coming from an equal high. Now, if these were soft higher lows like we had back here, it would be a different story. But because these are firm higher lows, because we're coming into the equal high, as long as the higher low is above 491.50, I would say we're good to go for trend continuation. You could even start thinking of it as building an ascending triangle, right? If you come in with a trend line that looks something like this, let's just speculate. And again, this is very, very speculative. Something does this, it's range compression, flat top, ascending triangle, looking for a break over time. So the line in the sand I would like to see on the daily time frame chart really hold up as support is that Tuesday high coming from the Friday breakout from what is now 3 weeks ago. Then we had the Wednesday gap up low on that previous week from 2 weeks ago. And then we also had the high of the Tuesday session. So 496, if it can hold in my eyes, would be the ideal daily higher low to offer something that looks like this, then possibly looking for that range compression into the ascending triangle that we were just talking about. That's what the buyers want to see here. What the bears want to see, of course, is sort of what I was alluding to a moment ago, where maybe this turns into a double top. We trade back down to the equal low and things really start to fall apart at 491.50. If we were to break down underneath that, I could easily see a world in which we come in for the weekly higher low test closer to that 480 zone. It's the daily 50 SMA and its previous structure down here at 477.50. We're not there yet. If we take a look at the daily bar that printed on the Friday session, as there was that sort of tension in the air, it was definitely an OPEX as well. So you're getting some sort of price pinning from that point of view. We've unwound all of the CPI gap down, and now we're just pulling back mildly off of the all-time high. So although, yes, there was tension in the air and it feels like everybody's holding their breath for the NVDA earnings, nothing about the structural chart on Friday was so dramatically damaged where we would start to say, okay, here come the sellers with some serious force. No, it was just a mild pullback. We undid a little bit of the Thursday session, came back into this. We started to find some buyers near the lower wick at that 498.25. We did close weak, don't get me wrong. I'm not trying to say that this is a bullish bar on Friday, but it's just not nearly as bearish as maybe it felt with that tension we've been describing thus far. So right now, looking for a higher low, continuing to sort of watch and look for follow through out of the uptrend that we're getting here, 496 key daily level. If we slip underneath it, the sellers definitely start to get the benefit of the doubt. Any lower highs start to become a concern. And of course, as we've already pointed out, falling through the neckline of this as a double top at 491.50 brings in much larger concerns here on the daily time frame. Let's continue to get granular here with an examination of the hourly time frame chart. What do we see from a trend point of view? The short-term trend is definitely up. We have lows, higher lows, and higher lows have been found in this area. Along the way, highs, higher highs, and of course higher highs into the end of the week before that Friday end of day sell-off to produce these equal lows. So that really brings us to our next point. Let's really dive into the price action of Thursday and Friday. Thursday morning, we were really just getting a balance range in here after a gap up. And notice that the first hourly bar is an inverted hammer. That nasty upper wick did start to show some signs of rejecting the Monday consolidation lows. So think about that bar like this. If the sellers were truly going to have a stronger upper hand, that's a great place for a daily lower high. And then you want to see the hourly trend reverse for a stronger downtrend to ultimately ensue and possibly jeopardize a lower high double top breaking down through the neckline. Obviously, that did not take place, and into the afternoon on Thursday, we did get that follow through in the upward direction. Friday's a different beast where we open at the highs of the Thursday session. We poke a toe underneath. So don't get me wrong, in a picture perfect world, buyers would not have allowed that. It would have been consolidated consolidation here, then follow through to the upside. But nonetheless, in that first hourly bar, you can see in the lower wick, buyers responded, and then we did get afternoon price acceptance back above the level here at $500.50. It's only that end of day sort of panic flush, with the addition of SMCI selling off aggressively, with the OPEX happening at that time. That, in my eyes, is sort of the catalyst, maybe also headline risk over a long weekend. Remember, the market is closed on Monday. That, to me, is what sort of kicks off some of the selling there. But notice it's after a very nuanced higher high into that afternoon session. So equal highs with the all-time high, closer to that 503, means on the daily chart we can afford the higher low pullback, and we've already described how 496 is the line in the sand there. So how might we actually get to 496? What is the risk here on the hourly time frame chart? Well, we know stronger sellers aren't really here. Otherwise, on the Friday morning session, consolidation should have taken place back down inside of the Thursday opening range, and then some threats for breakdown into the end of day. Simply not the case, right? So if sellers are going to make something happen here, I could see where maybe this turns into an M pattern. It's sort of a very compressed double top, right? Underneath this neckline at 498.25, we see the daily pullback to 496, and then we'll watch out for down here double bottoms, inverted head and shoulders, and as we know, the very classic simple hammer candle, right? If that starts to happen at 496, we know that we're getting buyers stepping up, and there's your daily higher low from here to over here. Now, if that doesn't happen, if there is no response at 496, if the buyers do not step up here, this is where I can start to extrapolate and imagine, again, that world where possibly that breakdown leads to an equal low attempt at the 491.50. A lower high then underneath 496 starts to set up the all too infamous Man Ray pattern here on Trade Brigade, right? So this is a trademarked, registered, and copywritten pattern. Do not steal it. We'll have the lawyers on you if you do. But there's the Man Ray pattern. A lower high underneath 496 does jeopardize, obviously, your daily trend. And then from here to here, coming into the equal lows after a lower high, that's where the breakdown of 491.50 starts to look more enticing for some more bearish style positions, and we'll aim for the weekly higher low. So that's sort of both sides of the coin here. Like in a picture perfect world, this just remains as a multi-day balance, right? It's really that Thursday and Friday is a 2-day range so far. If we just continue to consolidate here, and then maybe over time, right into the latter half of the week, we're getting consolidation over $500.50. I mean, this is totally just that range compression scenario I just described on the daily, where then we're looking for a breakout up and over 503. If you're not really in the mood to take breakouts here, because we know that the HYG junk bonds are slightly divergent, if you're like, I'm still pretty skeptical of this marketplace, that's fine. The next stage of the game would just be looking for the higher low over 503, entering on that pullback as certainly an hourly and daily higher low pullback, and trading in the direction of the trends, which do remain up at this point in time. So we talked about two different situations as to how this market could unfold, and I really do believe the largest levels to be paying attention to here on the hourly chart are 496, 498.25, 503. This is an intermediary here at $500.50. And then the big line in the sand from the daily is back down at 491.50. If we throw on the anchored VWAPs here intraday, let's take a look. You can see that we are getting huge support around that 498.25. So again, it's very reasonable that some sort of balance in here that respects the anchored VWAPs, that's totally bullish consolidation. There's really not a concern from that point of view. The lowest anchored VWAP is currently Confluence at the 496. So again, Confluence with that level gives us an additional sort of layer of confidence or trust, if you will, to execute on some sort of idea if we can find buyers there at the 496. Before we move along to market internals, let's finish it up with our Fibonacci's from the low up to the high. And here we go. 38.2 is 496. So if we were to get there from a daily point of view, certainly makes sense for a higher low. Let's take a look at the supporting evidence. So market internals are always Exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. There's really nothing here that would suggest the bears have an overwhelming edge. I would certainly concede the point, and we'll always give credit where credit is due. Tuesday was nasty. That's a given, right? We had the CPI catalyst, and the internals were very, very bearish. But on the follow-up days, Wednesday strong volume inflows, Thursday strong volume inflows, both of those days in trend higher zone out of the advanced decline line, and decent cumulative builds out of the tick down below. The one thing that's maybe a little bit shaky, as we're just balancing now for a 2-day range as described on the SPY hourly a moment ago, is that we technically had volume outflows on the day for Friday. Net flows on the week were still positive, up around 390 million. The advanced decline line tried to work its way higher, so it's not the end of the world here. I'd actually say that a more bearish advanced decline line would have possibly looked something like this, where we opened at 0 and trended lower all day towards our zone down below. It simply was not what happened there, and the cumulative build is completely flat, so there's not much to read into from a tick point of view. Very, very neutral at the the exchange level. So could I see a world in which we break down from the 2-day range, find the daily higher low pullback, because outside of just sort of neutral, maybe a little bit more bearish consolidation on Friday, there's really no stronger sellers, right? We've sort of established that. The place where I would be concerned is if we break down from this 2-day range and we do not find ourselves a daily higher low and the internals are nice and red to the downside. That's where I would say, okay, larger issues are starting to emerge. But as of right now, this is just mildly bearish consolidation, nothing to be overly concerned about yet. Exhibit B is always the market profile. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Let's take a look at the value area and point of control from the Thursday and Friday session in particular. And what you'll notice over here is that value area and points of control on the individual sessions are lower in the overall range and lower in the overall range. And the point of control is also lower from Thursday over towards Friday. And this is a very important takeaway to just understand that if, let's say, and as of right now, the overnight indication based on the little maintenance period before the closure on Friday, we're lower. Don't get me wrong, we are lower. But if for the Tuesday morning open, or let's say that Monday's shortened holiday session for the futures market at least, leaves us with price acceptance in the midpoint of this range, it's going to be very difficult to turn these folks into overhead supply until you actually break down through the lows of this 2-day range. If you're just chopping around in the range, I think buyers are positioned with decent location here and they will continue to defend. Now, the flip side of this coin, of course, is just that we're not getting any price acceptance, or at least from a transactions perspective, there's not a lot of price acceptance at these highs. So are buyers tired near this all-time high? It's certainly a valid takeaway, but I would be very cognizant of the fact that if you're looking for shorts, you really need to watch for the breakdown of the 2-day range. And then at that, we're still just trading back to the high of the Tuesday session, right? That's the equivalent of 496 on your SPY daily time frame chart. If that takes place, look at your point of control from Wednesday. It's technically underneath that level. So if you find buyers here at 49.90, I still don't think it's the end of the world. You would still maintain a daily uptrend in that case. Let's switch gears over to the QQQ NASDAQ 100 on the weekly time frame chart. What do we see here from a candle structure and location point of view? Unlike the S&P, it's not as hammer-esque. Don't get me wrong, there's still a larger lower wick compared to the upper wick, but look at the size of the candle body in relationship to the lower wick. It's not nearly in the same ratio as to what we just saw out of the S&P 500. So for that reason, I wouldn't quite say that the structure is as bullish here. The hammer definitely would suggest that buyers stepped up strongly off of those lows and were able to push at least back up towards the upper third. Not the case here in the QQQ. We've definitely closed in the lower third of that weekly range, or even just in the lower 50% of the weekly range. In terms of location on the bar-to-bar count, we're still getting an equal low and a very nuanced higher high, so maybe slightly bullish from that point of view. So it's a mixed bag here on the QQQ weekly. Momentum would seemingly certainly be slowing down. Doesn't change the fact that we're still in an uptrend with lows, higher lows happening here, and along the way, highs, higher highs, and of course higher highs from the Monday session of last week before the CPI gap down. On the weekly time frame chart, we know that our pullback zone is closer to 412, 410. Anything that looks like this is good to go, and the weekly trend will remain in the upward direction. Unlike the S&P, this is not quite confluence with the previous all-time high. The previous all-time high is slightly below that level, so we'd prefer to see 410 as a line in the sand here on the QQQ weekly in an ideal world. Let's bring out the Fibonacci's from the low of the October pullback to the top of the most recent rally. 38.2 still going smack through the midpoint, and if we bring in this one here, you'll still get the same gist as the S&P, where the weekly low did not violate the 38.2 from the January early year pullback that we saw to kind of kick off the year. So let's now move along to our anchored VWAPs, and these will still not really suggest much is in play. Still focused on that 383 monthly higher low thesis, just like the S&P. This one will slowly creep up over time. It's not quite there yet. You can see it's more so aligned with the bottom of the range, but over time, it may start to play catch up with the top of the range from over here. Once again, 410 acting as confluence. Let's move on over to the volume profile, and this, just like the S&P, not much to read into. Previous all-time high is important, and this, as a high volume node, did technically act as support in the lower wick of this week's session. So the fact that we've closed over that high volume node that's developing, again, not reading into it too much, but it is slightly more bullish than bearish that we were drawn towards it, and we technically closed above it. Let's bring out our extensions now. now and talk about potential for upside from the cup and handle pattern. And remember that this extension is far greater than the S&P because the distance of this move is much larger in terms of magnitude. The 61.8, before we get on up to the extension there, is actually acting as support. So it's not technically confluence like the S&P is at the top of the range, but the lower wick of last week's range is right off of it at 425. Interesting nuance from that point of view. The extended target, as we know, is closer to 475. We've been using that as a round number. It's a little bit more of a stretch compared to the S&P, but it is still a valid target to have on the higher time frames. For now, buyers still maintain control of the weekly time frame chart. Remember, your time frame of analysis must match your time frame of execution. If you're a swing trader, positional trader, this higher low cannot scare you out of the weekly time frame chart. You are looking for the opportunity of trend continuation as long as we're above on the weekly 410 to 412 as a zone. On the QQQ daily time frame chart, let's first evaluate this week's expected move. If we're contained by the upper bound, the number is at 439.53, implying a equal high to the previous all-time high. And you'll notice that the lower bound is much lower here at 421.57, implying a lower low. So for that reason, the expected move on the NASDAQ side of things is not nearly as bullish as the S&Ps. I would argue that this is neutral to bearish with that lower low suggestion here. If we take a look at what's happening from a trend point of view, we've got lows, higher lows, higher lows. This was your higher low. Remember, we did drift back into an hourly uptrend here, and now we have ourselves almost exactly what we were talking about in the S&Ps, the risk, right? You're getting a little bit of a lower high indication here. Now, I wouldn't throw everything out the window and say, okay, that's it, market's going to zero. It's not really how it works. We're just getting range compression coming off of that lower high, right? Because you still have the opportunity for a higher low, but of course you're dealing with a lower high. So the line in the sand must be this area right here at 429.15. We want prior resistance, 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 basically from the pie in the sky inverted head and shoulders neckline to now act as support since we've recaptured it on the Wednesday session. Remember on the Wednesday midweek market update, we talked about how crucial that lower wick of the daily bar was. It needs to continue to act as support here at that 429.15. Now, on the Friday session, unlike the S&P, we don't just have a 2-bar range. This is actually a bearish engulfer on the Friday session. So is there more weakness in the NASDAQ? The answer is absolutely. And for that reason, if you're looking for shorts in this marketplace, the NASDAQ is the place to do it. Now, again, I wouldn't be overly bearish if we're above 429.15. However, if we start to slip underneath on the hourly time frame charts, looking for lower highs below that level, start to jeopardize the trend here on the daily, right? We won't flip fully into a downtrend until we break down through the equal low at 426.25, but obviously that's the sort of implied threat if we get down underneath 429.15. So those levels are top of mind here early on in the coming weeks worth of trade out of the NASDAQ. 429.15 line in the sand. Below that, it's kind of like all bets are off, and we're definitely in a short-term downtrend when and if we break below 426.25. So once again, just to sort of summarize the pattern in force, it would be your lower high double top. Your neckline where the downtrend begins is underneath that key zone we just described, 426.25. So some more issues. We've been fairly clear about that here on the NASDAQ daily. Let's move on down to the hourly time frame chart. And you can start to see how on that Friday session, you did get that deep drive to the downside. You started to get some afternoon consolidation here, but remember, it's just not enough to get back up towards the equal high of the Monday all-time high at 438.50 on the NASDAQ side of things. So as soon as and if we break underneath this level here, this is kind of like a range breakdown on the hourly. You're definitely drifting into a downtrend with highs, lower highs into the afternoon. That's a very nuanced take here that we were not getting out of the S&P, right? The S&P found a higher high into the afternoon. Not the case in the NASDAQ. Lower high, equal lows breakdown. Again, 429.15 would be the level that I use because of the daily inverted head and shoulders neckline. Pie in the sky, yes. But if we break that, it's, all bets are off, equal low, and then lower highs here. Danger zone. Now we're in a daily downtrend, right? So that's really what the bears want to see out of the NASDAQ. If you're a buyer, you of course just want to see immediate support early on in the week for double bottoms, inverted head and shoulders, the whole 9 yards we're always talking about here at 429.15. And you instantly want to trade back up to the equal high. Now this again is the risk out of the hourly chart, is that the buyers need 434.65. If there's a lower high that's produced underneath 432.75, now all of a sudden this is like rounded top, maybe an inverted cup and handle, right? Where this is sort of your cup, the rounding top, if you will, in this situation. Lower high happens here. There's your handle, flush the bottom of the now upside down cup and handle, and we're talking about downside, right? So we can clearly see why there are more issues here with the NASDAQ side of the market. Buyers feel much more confident, like huge sigh of relief if something like this can happen. If we were to get a higher low over these equal highs at 434.65, it's like, okay, here we go. Back in store for the daily uptrend to be intact. Hourly is looking for the equal high, all-time high, 438.50. So for that reason, your key zones are really just all in a row here. 434.65 needs to be cleared for better bullish activity. Underneath 432.75, the hourly risk is for the lower high. That's dangerous because we know falling underneath 429.15 is the daily line in the sand, and then you're definitely in a daily downtrend underneath 426.25. Let's take out the Fibonacci's from the bottom of the move over here up to the tippity top, and you'll notice that you're not really getting much confluence with the 38.2 at the level here, but you are starting to get some support at the lows of the Friday session, so maybe that's slightly helpful. To me, I would really look more so to the 61.8 acting as a line in the sand closer to that 426.25. As we described, breaking underneath that is definitely your daily downtrend, and perhaps on the higher time frame hourly or zoomed out hourly look, maybe you're getting head and shoulders from that point of view there. Let's go ahead and bring out the intraday anchored view apps for the NASDAQ side of things. And yes, I do believe that because these are more so clustered in the same zone, any early week price acceptance below or near that 429.15, you're underneath the cluster. It's going to be much more difficult to find that bullish rotation where the higher low is found over the top of 434.65. So like I said on the daily chart, if you're looking for shorts in the market, the NASDAQ is the place because it's so concentrated in tech. It's really the concentration here and the lack of diversification that the S&P has via multiple sectors, right? This is just all tech. If there's a weakness in tech, if people are like, that's it, NVIDIA, SMCI, the whole chip thing, it's up, the gig's up, this is where you want to be short, definitely not over in the S&P side of things. Let's move on over to the market internals for the NASDAQ, and I would have similar commentary over here with maybe the caveat that the Thursday follow-up session really wasn't as strong as the S&P. See that we did not get strong volume inflows on the individual session. The advanced decline line, although it did close in trend higher zone, it was not just straight across like it was in the S&P, and the cumulative build out of the NASDAQ tick is much weaker on both the Wednesday and the Thursday session. Friday's even a little bit more bearish here, a little bit more of a fall off into the end of day, and this as well is well underneath the zero line. So, I think that this just really sort of adds into or ties into the thesis that shorts are better off on the NASDAQ side of things. And lastly, to finish up our NASDAQ, let's take a look at the market profile through the lens of the NQ futures. So poor low is first and foremost. Let's just zoom in on that, make sure we're not deceived here. Maybe a little bit of excess. I would call it lack of material excess considering the ranges that we've been traveling recently. If we look at what's happening with the value area and point of control, it's the exact opposite of the S&P, right? Notice that the value area on Thursday is higher in the range, as is it on the Friday session. Point of control is higher, point of control is higher. So all it's going to take is a breakdown underneath that low from Friday, and I think we do have overhead supply already. We talked about how there was a bearish engulfing bar on Friday instead of just a sort of sideways neutral range. Definitely looks more bearish on the NASDAQ. And lastly, for the broad market indexes, we have IWM Russell 2000 and the small caps on the weekly time frame chart. What do we see in terms of candle structure and location? This is definitely a bit more constructive than the NASDAQ with a long lower wick, green-bodied bar, but a little bit of upper wick, certainly worth respecting here as well. I'd call it a hammer-esque style bar, but it's not great. That upper wick is a little bit larger than the candle body, which is not an ideal situation if you're looking for strong buy-side close at the highs of the weekly range. Nonetheless, on the bar-to-bar count, we do have ourselves a higher low as well as a higher high, almost an equal high to what we got back here from the wall-to-wall move bottom to the top of this as an overall range. The strongest takeaway still on the higher time frame chart Russell is that this is acting as a firm weekly higher low now that we've traded back up to the equal high. And as we know, as we scrunch this chart out here, if this range gets a solid range break, a doubling of the range, which is always just a classic measured move of a rectangle, brings us closer to the all-time high back here, maybe 235, 237s as a valid target. And as we know, as we continue to extrapolate the story here for the broad market as a whole, the IWM playing catch-up is helpful for the S&P. Not the NASDAQ, but definitely the S&P 500. This will act as a tailwind, the broadening nature of the market rally for the S&P 500 to perhaps continue, or at least just see muted drawdown if the NASDAQ is going to go into this big phase of bubble bursting. Again, we're not there yet. We've talked about weekly downtrends in last week's episode of the Weekly Watchlist when we're comparing back to things like the dot-com bubble as well as the great financial crisis. So anyways, back to IWM and small caps. This is looking constructive, and again, very pleased with the weekly higher low. You could start to consider this a weekly bull flag. It's all happening over the weekly 200 SMA, certainly above the weekly 50 SMA. If we bring out a Fibonacci from the bottom of the move up to the top of the move, we've been respectful of the 38.2. If we bring out this fib from the all-time high to the lows of back over here, we're spending more time over the 38.2. Notice the lower wick of last week's bar supports right off of that area. So to me, that is constructive. It's a step in the right direction. We really want to get out of this as a range, and more importantly, from underneath that 38.2 on the higher time frame there. If we pull up more time, let's go to a 5-year chart, and let's go ahead and bring out the anchored view apps on the weekly. You'll remember that this cluster is underneath us, acting as support, once again confirming or sort of adding to confidence here in the weekly higher low. So really still constructive on the IWM higher time frame charts. We could also bring out the volume profile, and what's interesting about this, we haven't checked in on it in a long time, but the highest volume node is down below, and you're starting to get some price acceptance towards or even above this high volume node, which marks the top of the range. And again, we haven't checked in a while, but this low volume void has not gone anywhere. If there is a break through that, again, this is making much more sense that you get closer to the range double target, somewhere around 230, 235 is a little bit more precise, possibly these highs from in the past before the all-time high. So still very constructive here on the higher time frames. Russell, things would start to deteriorate more meaningfully when and if we take out these lows, right? The bears ultimately want to see a weekly double top, but it's not going to happen until we actually break down below roughly 190 here in the IWM. IWM daily time frame chart. Let's first evaluate this week's expected move. Upper bound at 206.74, implying a higher high, and lower bound at 196.50, implying a higher low. So expected move is slightly more bullish than bearish. If we're thinking about daily trend, remember we're going to start counting from the weekly higher low, which is here. We have lows, higher lows, higher lows. Along the way, highs, higher highs, higher highs, higher highs on Thursday, meaning that we can certainly afford a pullback searching for a daily higher low without jeopardizing the overall uptrend that we're in. The key level, the line in the sand, if you will, is going to be right here at 199, or a gap fill reversal slightly higher than that over the Wednesday high of day at 199.80. If we could do something like this, that would be beautiful, because as we know, what we're trying to align with here on the daily time frame is this as a larger double bottom to flip back into a daily uptrend, which we just confirmed we're in with the higher lows and higher highs. Now, of course, we want to respect that neckline. What once acted as resistance now wants to be seen as support. Again, that number 199, or the gap fill reversal over Wednesday's high at 199.80. The Friday bar is not all that encouraging. We do have ourselves an inside bar, so it's not like we expanded range to the downside. However, it's an inside bar inverted hammer. So in that upper wick, we know sellers stepped up and they were able to close prices underneath the opening print, threatening a 2-bar low breakdown. This seems like a very real possibility early on in the coming week's worth of trade. So I'd be looking out for the gap to close first, considering the nature of Friday's bar here. If we are looking for a movement in the upward direction, say it's consolidation and then a break over 205, which is this previous high and loosely the high from Thursday, the next target overhead structurally is at 208, a slight extension through the upper edge of this week's expected move. Would I be bearish on a breakdown underneath 199? Not the end of the world. I do still think there's an opportunity for maybe a higher low at the lower edge of this week's expected move. Again, 196.50s would be the number, but the threat would then turn into, of course, as we've already been describing in many charts so far, the lower high below that level starts to make this feel like a failed breakout attempt, and now all of a sudden you're starting to jeopardize your weekly higher low at 190. So we'll change our tone when we have to. As of right now, we're still going to align more so with the bullish nature of the market here. Let's move along and take a look at the hourly time frame chart. You can see these very sort of, they're very, what would you say, harmonious breaks in the upward direction. Very tumultuous week last week as well, just to continue along with the big vocab words of the day. Big downside followed by big upside, and then a neutral Friday as we were sort of getting that tension in the market. So, I don't really look at this chart and say anything more than just, okay, if we go for the gap fill, I'm looking more so for the daily higher low here. Can we stay outside of this as an overall range? And even if we poke into it, can we get a higher low over the Tuesday low? And once again, that number is at 196.50. So this chart isn't really offering much. This, of course, would be consolidation. It would be healthy consolidation. No need to get really forensic here. Obviously, it was a gap and go on the Thursday session, so there is no stronger indication of sellers. And I think we've sort of hit the nail on the head here from the weekly all the way down to the daily and now hourly. It doesn't make sense that there's like all of a sudden going to be this massive rug pull and small caps are going to zero until we actually violate the weekly higher low zone, which is way down here at 190, right? So we've got plenty of support points, stopping points here, checkpoints, if you will, before larger concerns start to emerge. Let's bring out the Fibonacci's firstly from this low. If we could get a click up to the highs in here, and you'll notice that the 38.2 is beautiful confluence at that 199, supportive of the idea that this makes sense as a higher low. 61.8 is loosely mixed in here around that lower edge of the weekly expected mover. Again, that's 196.50. So as a line in the sand, that's also adding up. And let's finish it off here on the hourly with our intraday anchored view apps from all sorts of places here. You're getting some loose confluence with these two at 199 or the gap fill reversal even better than that. And this is also small, subtle confluence with that 196.50. Daily 50 SMA is slowly going to creep up and meet us there as well. So I think we're good to go from a reference point perspective here to remain bullish on the IWM. Of course, as we talked about on the daily chart, we would be more so concerned if something like this starts to emerge, then we get a lower high under 199 and a breakdown to something like this. Now we're starting to say, all right, that weekly higher low is in jeopardy. Again, nothing about the current structure would suggest that that is an overwhelming possibility for the upcoming week's worth of trade. Maybe if NVIDIA, hugely misses on earnings, just the impact that it's going to have in general on the market, maybe that's a possibility. But again, one day at a time. Let's not try to get ahead of that. Let's respond to it when it takes place. Let's finish it up with the internals for the Russell side of things. You can see some more weakness on that Friday, especially as we're consolidating for an inside bar inverted hammer. But notice on the Wednesday and Thursday, still strong volume inflows on both days. Not the best show here, dipping out of and then recovering back into. So it's not terrible, but it could be better like the S&P. And then the same thing out of the cumulative builds here, a little bit more bearish on Friday. So in my eyes, based on the internals, based on what we can see here from the Friday sort of rollover into the afternoon, wouldn't be unreasonable to look for something like this first out of the IWM. Let's finally finish it up truly with our market profile look. And the most interesting takeaway here is actually just the double distribution from the Thursday session, right? This I period separates an upper from a lower distribution. The point of control was higher, and obviously we're lower on the Friday session. So as a theme we've been talking about, what would that imply for the buyers who are trapped at the highs, right? It's going to be easier for them to turn into overhead supply on a breakdown of the two equal lows, looking for that pullback. So I think that the pullback first and then looking for buyers to respond at a daily higher low makes the most sense out of small caps. Let's continue to take a look behind the curtain here for the S&P. Evaluating the weekly performance of the sectors reveals that energy led the pack up 2.36%. It was followed by materials, the XLB, 2.2%, and then utilities up 1.59%. And if we ask ourselves the question, are these heavyweight risk-on style sectors, the answer is absolutely not and absolutely not. So they're all lightweight in nature, and specifically the XLU utilities are D for defensive. So this is not really what we want to see posture-wise as the market's making a move back up towards the all-time high here. So a small red flag is starting to be raised in our analysis of the markets. If we take a look at the bottom of the barrel, it's the XLK tech sector, down a whopping 2.53%. That's the heaviest weight risk on style sector, so not ideal to see that as the market's again attempting all-time highs. The SMH follows, not necessarily an S&P sector, but down 1.2%, semis there. And then the XLY, consumer discretionary, down about 0.5% on the Friday session. So posture does not strike me as being strong as we're making that stride and step towards an equal high at the all-time high. Let's check in on the structural charts themselves and see what's going on from that point of view. So energy is certainly breaking out on the Thursday session up and over this neckline here. The key question becomes, is it going to turn into a fake break like what we saw in the early stages of January. And if it is, that really wouldn't speak too well for the economic conditions globally, right? Demand for oil has some sort of impact there. So it'd be ideal if this could break out, but in terms of posture, we don't want it leading the S&P towards that all-time high. Again, great, upward pressure is upward pressure, but if the S&P 500 itself as an index is making new all-time highs, energy should not be the sector to sort of lead that effort. If we move along to the materials sector, it's the same commentary over here. This is not necessarily a risk-off sector, but it's extremely lightweight. It's the lightest weight sector in the S&Ps last I checked. So, big breakout here out of the range. If it pulls back, it's not really going to hurt the S&P because it's such a lightweight sector. But as we're breaking to new all-time highs, again, the posture here is just not totally adding up for a purely risk-on style move, especially as we take a look at utilities. Now, utilities on the structural chart is still offering some sort of downtrend here with the capacity for a lower high. So I wouldn't look at this and say, oh my goodness, let's run for the hills. Defensive stocks are leading as we're making that new all-time high push or attempt. It's not the case at all, but we want to keep a close eye on it. If this turns into some sort of double bottom, if utilities were to recapture 63, and if that's what leads the S&P to a new all-time high, you better bet your bottom dollar I am not buying that all-time high if it's being led by utilities here on a break of 63. Moving along to the XLF financials, I do believe that financials could come in and save the day as we're seeing the XLK weakness, as we're seeing potentially some pulling back and some consolidation out of the tech sector. Financials breaking out of this range here has the ability, as the third heaviest weighted sector in the S&P and also being a risk-on style sector, if this can get continuation or just spend generally more time over 39.50, that would be bullish support for the rotation perspective in the S&P as a whole. So watching that very closely, we want more price acceptance over 39.50, bullish 3-bar play unfolding on Friday. Let's see if Tuesday we can break the equal highs and get one more momentum push in the upward direction. Beyond that, I would start thinking about, okay, there's your daily, weekly high or low over the breakout level, and we'll look for continuation into 40.40. The worst thing that could take place for financials would be a look above and fail. A lower high back down in the range, and I would sort of think to myself, okay, S&P, you lost the one saving grace sector-wise that was starting to look somewhat promising, so XLF will be a top watch for that reason into the coming weeks worth of trade. Next up, healthcare. Healthcare, new all-time high, big inverted hammer on Friday, totally reasonable for a pullback. Higher lows are on the table, above the previous all-time high at 143.42. No big concerns out of healthcare, second heaviest weighted sector and D for defensive in nature though. If we take a look at industrials, again, new all-time high, pullback, higher low, certainly on the table. So let's not get it twisted. I mean, the posture was not great as we're breaking towards those all-time highs. However, the structural charts are not really deteriorating in a meaningful way where we would say, oh my goodness, risk off is here, the market's going to go to zero. It's just not the case. We have plenty of places for higher lows when and if we pull back, but obviously that means a pullback in the index itself, perhaps more vicious than what we saw with the CPI gap down. Instead, maybe it's a controlled pullback on the daily that achieves a weekly higher low or something of the sorts, right? We're keeping an open mind to that as a possibility. Here's the XLP consumer staples. Not much of a concern happening over here. Ideally, this just continues its little uptrend. We have lows, higher lows, higher lows, higher lows. Very simplified trend there, but for the most part, no concerns out of this chart. It's also not pushing and breaking new all-time highs, so leadership-wise, not an issue. Here's the XLK, and although it underperformed on the week, it was at the bottom of the barrel. Again, look at the chart here. It's very difficult to say that, oh my goodness, this chart looks horrendous. I mean, I could certainly concede the point that, yes, there's an opportunity for one of these guys to start to emerge, break the neckline and sudden you're lower. But, I mean, we're just digesting some of these very, very parabolic gains that were produced in the early stages of the year. If this either consolidates sideways and this is a box, I would not be concerned from a weekly point of view. From a daily point of view, yeah, if we break down underneath $200.65, that would typically, in my eyes, start to spell more pain for the S&P 500. So we're trading for that pullback as an outcome. But overall, on the higher time frames, is this detrimental to the risk on versus off sentiment? I would have to say no. Let's take a look at the SMH. It's going to be a very similar comment over here. Again, this is not very bearish. It's just a consolidation. It's price acceptance near these highs. If anything, maybe this turns into a double top. There's sort of your M pattern there. It would have to be a breakdown underneath 196. So if we're just consolidating up here, I would find that very difficult to be in a bearish environment. I would tend to just think digestion of the gains that we've seen over here. So I know it's attractive or maybe tempting to want to have that bearish narrative and say, oh my goodness, yes, the market's going to go to zero. Let's get all hyped up on this fear narrative. perspective, it's not there. It's not there. We have not broken any key structure yet. Here's the XLY, still like towards the bottom end of the barrel, but if you look at the chart, it retraced all of the CPI gap down. Now there's an opportunity for a higher low back above the top of the range. It's very simple here. As long as we're over 176.50, there's nothing more bearish to say. If we do break down underneath, great. It turns into a double top. We'll trade back down to the bottom end of the range, and yes, we'll change our tone likely in the S&P and the broad market. There's just no indication of that right now. If the sellers were going to be strong, they should have done something here with that gift on CPI. It just was not the case. The next possible gift that they could get is, of course, NVIDIA earnings on the Wednesday afternoon session. Here's real estate. No concerns over here, even after the rate breakout. We'll look at the TNX in just a moment. It's right back out of this previous zone. So any issues? No. Let's take a look at the XLC. What's going on in communications? A little bit of look above and fail indications here, but still sideways in the range. I would say that the gap close underneath is a bit more dangerous, but even at that, you're talking about a weekly higher low at 77 roughly. The issue would become any sort of lower high in here that changes the daily trend. Okay, now we have to be a little bit more concerned, but as of right now, this consolidation, not the end of the world until it is, right? I would not panic unless this is taking place. It's very possible that you either get sideways here, you get sideways to break, and then obviously you want the higher low over 80.05, the top of the range in here. So it's just too early to say that, yes, this is it. This is the end. This is the top. We're not seeing that evidence at a sector level. Here's the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. This is starting to become slightly concerning here, especially if we start spending more time underneath the 50 SMA. The one sort of balancing point, which hopefully you've gotten the gist from the structural charts, is the XLF financials recapturing the 50 SMA. This is exactly what we talked about in the Wednesday midweek market update. You can go back and watch that video. We said, hey, if we break out of the consolidation range, we really want to get up and over the 50 SMA, and that was accomplished into the end of last week. So that is helping counterbalance some of the small and subtle weakness we see in the XLK. This leaves a bit to be desired. You're starting to get a bit of a rounded top feel here, just flat highs out of the XLY. You want to break that and get back to the 50 SMA, very similar to what happened here. You want to get to that level. You don't really want to roll over underneath it. This is something we'll keep an eye on, the relative outperformance from healthcare as a D for defensive sector, but as we know, it's the second heaviest weighted sector, so if any of the defensives are going to outperform by being over the 50 SMA, this is the one to do it. And speaking of defensives, I mean, this is still not a threat. This is still not a threat. Keep in mind, there's small upticks happening here, but they're not in uptrends. It's the simplest way we can put it, right? XLC rolling over a little bit, offering a lower high here. Would be more concerned when and if it breaks through the 50 SMA. And industrials, as we know, also more of a risk-on style sector, but not nearly as heavy weight as what we have in the top quadrant. It's just kind of more neutral from that particular perspective. If we take a look at some specialized ratios, here's the XLK over the SHY. It's pulling back a little bit, and we've seen this pattern sort of emerge in the past where you get these very short-term like double tops, you break down a little bit, but it's still not the end of the world. Here's another one, a little bit of a double top, deeper pullback here. So if this is going to act as your double top, or even maybe it's a higher high double top from here to here, a deeper pullback is not necessarily the end of the world, but we would want to see it get picked up for a higher low above this previous low over here. Same commentary in the XLK over the XLU. You can see that we're getting, again, a little bit of that double topping activity. If we break the neckline, certainly want to catch ourselves for a higher low at the upward sloping 50 SMA. So these are not yet like, oh my goodness, run for the hills, the market's flipping risk off. It's just suggesting that it wouldn't be unreasonable for a bit of a pullback here, which is mostly in line with the narrative that we've been walking through in today's session. Here's apples to apples, XLY, XLP, consumer discretionary and consumer staples. This, again, as a more apples to apples comparison, looks great, staying up and over that 2.38. So the higher this goes, the more risk on the nature of the market move. So right now, this would more so align with the bulls being in control, as with this ratio over here. The SMH semiconductors versus the XLV healthcare sector. It's still very mild pullback up here. Again, you could even look at this as a very nuanced double top and compare it to maybe what we have over here. Pull back, see if we can support around the 50 SMA, then get another leg higher. Again, pullback narrative seems to make sense as we look through some of these things, but not an Armageddon style sell. Here's the dollar. The dollar just cooled off and unwound the move from the Tuesday session. So as this moves lower, that's going to alleviate some of the headwinds for equities down below. And one of the things we actually talked about on Wednesday was the gold contract finding support at 2,000. 20,000, offering a headwind for the dollar, right? And if the dollar moves lower, that's going to help equities move higher. So that ultimately did take place into the end of the week, with gold supporting over 2,000. The longer that can hold above, the more bullish that would be for equities based on this entire relationship. If we take a look at silver, silver also got a nice little bid off of its support here at 2250. Would love to see this to continue up and over sort of a neckline of a double bottom like this. That would be at 23, let's round up there, 23.43 out of the silver contract. Moving along to interest rates, we can see over here that we did get a higher low on the Thursday session, and on Friday, we're right back up at that it's 4.33 in the 10-year yield. In the TNX, it's going to be 43.33. This really, like in my eyes, is a pivotal area for interest rates. And, if we're going to be bullish on the market, the best thing that could happen here is a move lower underneath this neckline, forming a bit of a short-term and nuanced double top. Breaking down underneath 42 alleviates a lot of the pressures down here in equity markets. However, I'm not convinced that this is going to be as easy as maybe the technicals might suggest, right? If we look at this chart, it's like, sure, we have prior resistance, we broke above it, and now it has the opportunity to act as resistance again when testing from the bottom. Maybe it offers a weekly lower high. The reason I don't think it's so clear is because of the data we've been getting from a fundamental point of view, which is a great segue into the inverted ZT as we start talking about, 2-year expectations and what this means for the Fed tracker tool. Tuesday was like a freebie, right? Obviously, with the hot CPI, we're not expecting the Fed to cut rates in the May timeframe meeting. Then we get a hot PPI on Friday as well, and we move higher but close slightly underneath. And I think the takeaway here is that rates on the longer end of the curve are going to start to move higher, even if short-term rates kind of fizzle out because of the expectation that Fed, will cut rates here very shortly. We're still talking about June. That's 4 more months of higher for longer without budging from Powell. So we'll keep an eye on the commentary, but the fundamental data, the way it's been coming out, is suggestive that monetary policy basically needs to be tighter than it is currently. If we take a look at what's been happening with financial conditions, right? Let's go on over this chart really briefly. Financial conditions have been easing, right? And this is not going to make Jerome Powell's job any easier. He basically is like, we want to see inflation continue to cool off. For that to take place, you really want financial conditions tighter, closer to the zero line here, not drifting in the downward direction. So we'll continue to keep an eye on this stuff, but for now, let's move on over to the tracker tool. So here's your higher for longer, and then if you take a look at what's happening into the end of the year, there's cut 1, 2, 3, and only 4 cuts into the end of the year. Remember how important this is, because originally, the early stages of 2024 were pricing in 6 rate cuts. Remember that the Fed meeting minutes would only suggest 3, and that's potentially going to move in the downward direction, revised to 2 when we get the updated SCP in the next meeting. Watching out for that very closely. If we go down to 2 cuts, the market is going to there's going to be a balancing act here, and we'll talk about PE versus earnings in just a moment. But last week was all about CPI, right? And what happened with the hotter than expected read. You can see on the core month over month, we got a 0.4 versus a 0.3, and the year over year, which is not listed here, unfortunately, came in flat unchanged. We got a 3.9, which is certainly not 2%, which is the Fed's target, right? So there's still work to be done on the inflation side of things. Core retail sales contracted aggressively, perhaps chalking it up to seasonal factors. There was a lot of spend in the previous cycle for perhaps the holiday season, and now it's people may be pulling back a little bit on spend there. The next biggest thing on the Thursday session was, of course, the unemployment claims, just not even close to becoming an issue here at 212,000 versus the 219,000 expectation. Remember that Toast can anecdotally say, hey, we're going to lay off 5,000 employees, but unless this number on a weekly basis starts breaching 250,000, it's just not going to move the needle for the labor market, which is really mandate number 2 for Jerome Powell. He likely saw the inflation prints this week and started to say, okay, with inflation reaccelerating, it's less about the equal balance of risks in the labor market and inflation. It's more back towards price stability. We'll see if there's any commentary on that as we move through this upcoming week. Core PPI coming in hot as well on the Friday session. No surprise there. 0.5% on the month over month versus a 0.1 expectation. And also of note, inflation expectations ticked higher slightly. Nothing meaningful here, but if that continues in the upward direction, that certainly would become more of an issue for the market trying to make progress on inflation. Remember that expectations have a direct correlation with what ultimately happens in the number and metric itself. Here is just, let's point out on the Friday session, PPI. Services was the biggest driver of PPI inflation there. So So that's adding up with what we saw from the CPI report, and it continues to be the stickier side of inflation. If we take a look at commodities have continued to drift in the downward direction, so you really shouldn't be seeing any goods inflation dramatically accelerating. This is what it looks like when goods inflation is going to sort of get out of control. This is not the case here out of the commodities index. If we go back to the calendar, what we have on tap for the upcoming week, obviously we know that Monday is a bank holiday, President's Day. The futures will be open until 1 p.m. Probably not worth trading and just enjoy the day off, but just as an FYI. And then it's Wednesday, FOMC meeting minutes, unless there are updates that the Fed interjected after the fact. Nothing new there. Maybe just a little bit of volatility, but no new information. Unemployment claims next week is really the largest issue, and we'll see if we come in hot, light, and what the sort of deal is from that point of view. As of right now, the labor market is becoming less of a concern compared to price stability. The market's probably more so concerned with inflation after last week's reads. Let's talk about earnings. If we take a look at the FactSet data report, blended earnings for the fourth quarter is up now to 3.2% from 2.8% at the end of last week, and it's due to multiple sectors reporting positive beats, but the noteworthy ones are, of course, here in information technology. The heaviest weight risk-on style sector moved to 20.8 from 20.2. That's a pretty decent step in the right direction. And then you can see down below, industrials also moving higher here, 6.4 versus 5.3 over the prior period. So that's a decent look there. And this is where we start to sort of see the concerns of what could happen this week, right? What did NVIDIA contribute to the blended year-over-year earnings growth rate? Oh, man, right? So if you take NVIDIA out of the blended growth rate, you're moving from a 20.8 to an 11.5. So you want to tell me about the market holding its breath for these NVIDIA, sort of earnings calls and guidance reports coming on the Wednesday session? Huge deal for the valuation of the S&P 500. Watching that very closely. A lot of this has been confirmed, right? We've already baked that in, what's confirmed for Q1, 2, and 3. It's really all about those Q4 earnings to see whether or not it's going to continue to pull the blended result in the upward direction. And you can see here that earnings have actually started to flatline in terms of EPS. We did get this rebound happening off of the lows, and that was positive, especially as we were talking about, hey, rates are really not going to come down as the market was forecasting, and therefore PE ratios should also come down to reflect that. You'll notice that earnings ticked higher, and that was going to start to add some of that balance, but notice now they're really just flat here in the 2024 and 2025 bottom-up reports, and here is the PE ratio. You can see ultimately it is not pulled back, even in the face of a market that's starting to understand, hey, cuts are not coming in March, they're not coming in May, maybe they'll start to show up in June. This continues in the upward direction. So if there is going to be a reckoning from a fundamental point of view, this is what we need to focus on, and it's all going to boil down to what happens on Wednesday after the close. You can throw everything else out here on the list. You could say Home Depot, it's important. Walmart, it's important. Yeah, it's important. But the only thing that's going to matter next week is this name right here, NVIDIA earnings Wednesday after the close. It's all eyes on it. Once again, as we talked about earlier, do we want to try to short the market? Do we want to try to get in front of this thing? Is it even going to be a bad beat? We don't know. I have no idea. I am not the type of trader to gamble on earnings. If you've been around the channel, you know that, right? So we'll watch to see what the reaction is on Wednesday, and then we'll play in the aftermath come Thursday and Friday. The market's appetite for risk is basically unchanged. There is no flight to safety trade unfolding here in the TLT ratio to the S&P. If people were more concerned about massive underperformance from equities because of some sort of fear in either inflation coming to rebound or NVIDIA earnings missing massively, if there's some sort of hedge taking place there, you might see some outperformance from the TLT. It's just not the case based on the ratio we can see here. If we move along to bonds in relationship to themselves, they do continue these very mild drifts in the upward direction. We've already built our case here, and I feel like I am a broken record on this point, with credit spreads not really suggesting any expansion of credit risk. There is no heightened sort of like, oh my God, there's going to be some sort of default out there. Not the case. These remain fairly respectable down here underneath descending 50 SMAs. Just as a brief reminder, these red boxes represent the Silicon Valley breakdown. If we move along to the HYG in isolation, this is where we start to say, okay, it would make sense, again, for the pullback idea that we've been describing so far to really unfold based on not only the sectors, but look look at your HYG drifting with these lower highs, and the S&P finally just made an equal high. It stopped making a sequence of higher highs in the face of lower highs over here. So there are two ways this resolves, obviously. Number one is that this breaks to an equal high, and we're good to go. It's just buyers, in control here. It's a higher low over that 496, and then we're looking for a rotation back to the all-time high as this potentially breaks out over 78 for a higher high in lockstep. If this continues the downtrend that's happening here, it's very minor, but lower lows as well as lower highs. If that continues and we drift for another lower low after this equal high, I would be more so inclined to say that yes, the S&P can look for a stronger pullback on the daily time frame charts, or even a weekly pullback to achieve that higher low closer to the 480s. Now again, I don't want to be doom and gloom. There's nothing about this as a sold data point that would suggest, okay, load the boat on shorts down here. It's not the case. It's just one back pocket data point that we have. Let's move along to Bitcoin and take a look at what's happening in the digital gold. You can see we're breaking out, and this would speak to a strong risk appetite for riskier financial instruments, right? So that's also aligning with more of a risk appetite for equities. If we take a look at breadth, new highs versus lows, actually recovered into the end of the week here. Solid look, really solid look into the end of the week, staying positive and sort of preventing the decline that we saw earlier in the week. If we just quickly flip to a daily chart here, yeah, look at that Tuesday, right? When Tuesday's breakdown from CPI came, we were back down towards the zero line. That was a concerning look. The fact that this rebounded so aggressively does strike me as a bullish data point. If we take a look at the SPX A200R, this also rebounded from a negative extension here to basically flat, so no issues out of that. And the SPX A50R, this is now a daily time frame chart already, you can see that sharp rebound off of the 50% mark, which is a bullish line in the sand. So all good breadth-wise, and the strongest indication still tends to be this RSP equal weight over here. Notice the break up and over the flat highs, the rebound after the CPI breakdown, and the consolidation on Friday was within that Thursday session range. So, this totally would suggest, okay, you don't want to short the market just because you believe it's being led by, the one stock to rule them all, NVIDIA. Sure, is it playing an important contributing factor? Absolutely. But the RSP is telling a different story here, where there's actually more participation taking place as we're starting to break and spend more time above this as a neckline. Let's move along to the QQQE. It's the same comment over here, where the equal weight actually performed better than the lower high that we're seeing out of the weighted down below. And the Dow Jones Industrials versus Transports continues to be more so divergent than our equal weight indexes, new highs, all-time highs in the industrials, whereas transports did pull back more aggressively here. And notice that you didn't hold that ideal higher low at the 15.7 mark. Zooming in down here, see on Tuesday, we went right to it, started to rebound. Friday's breakdown might suggest, again, that a deeper pullback in the broad market as a whole could be slightly more appropriate. I would be more neutral on the market and say, okay, let's forget about the pullback thesis if this kind of found a higher low and rebounded here into the end of last week. Let's check in now on volatility and see what's going on with the VIX. Big spike, no surprise. We talked about that on Wednesday, immediately underneath on the Thursday and Friday session. So as long as we're not getting acceptance, I would say over 15, it's not really a cause for concern. And we know if we take a look at volatility of volatility, again, big spike, but certainly in a comfortable range that we're very familiar with. No issues with this out of the VVIX, right? So volatility not really coming home to roost. If it is going to increase, I imagine that would tighten financial conditions to some degree. VIX futures, strong contangos over here, no issues with backwardation, not even close to the zero line. 9 versus 30-day VIX moving lower, and the one-day VIX also contained, still elevated in relationship to the Tuesday sort of issue, if you will. Monday actually saw stronger implied volatility on the one-day versus Tuesday, and just not even close to spending elevated time like in a box like this, right? All, or most, I should say, of the bodies are opens below, and yes, the one-day VIX, of course, has this phenomenon of trending in the upward direction, but we're not over that threshold. We're probably going to start watching quite closely, actually, 13 flat out of the one-day VIX. So we'll keep an eye on that one. And lastly, for volatility, let's take a look at skew just because we brought it up in the last couple of episodes, dramatically falling off here. So people betting against this sort of Armageddon breakdown or black swan at some point in the distant future, slightly less than over here, but still elevated nonetheless inside of this box. Let's move back on over to the trade tab here and take a look at NVIDIA. We just want to look at the skew on the actual chain for the upcoming week. Yeah, you can see that there is actually, we're back. Oh, we've normalized. We have normalized out of NVIDIA, where you can see the call side IV is certainly less than what we have out of the put side IV. So last week it was skewed backwards, right? We actually had a backwardation out of implied volatility calls versus puts. This week it is scheduled for normal, and I think that this likely comes on the heels of the takeaway from SMCI's breakdown on Friday. If you've made it to this point in the episode, I'm sure you're enjoying the analysis. Do me a favor, hit the thumbs up button, subscribe, all that good stuff, and we'll kick off the core list of companies with none other than Apple, who is on the fall from grace, right? On the daily time frame chart, we had an all-time high, lower high rejecting the 50 SMA on the daily. And you can see on Friday, we also started to reject the daily 200 SMA in green at 184. So we're definitely in a daily downtrend happening here with highs, lower highs, lower highs, lower highs. And the idea is, can we produce the equal low at 180.25? If that breaks down, you certainly have yourself sort of a descending triangle from this point of view. But if we look left, we have thin structure to retrace. Maybe there's a little bit of support happening here at 176.75, but the better target would be where the gap sort of gapped up from. And then when we gapped down, it was a very interesting interaction back there near earnings, right? 173.75 is that larger downside target where maybe there's some previous structure to start basing some ideas off of. But as you can clearly see, it's a long ways to go underneath 180.25. If we take it on down to the hourly time frame chart, let's just talk about what the buyers could have done on the Friday session if this was going to turn into an inverted head and shoulders, right? Because on Thursday, we got this really odd end of day rally, right? If that was going to be a higher low and then an equal high breakout, great. We would have looked for upside to maybe close the gap and then daily lower high in the zone, looking for rejections, inverted hammers, double tops, the whole 9 yards on the retest of 187.50. Simply wasn't the case. You tried to break the 184, no dice, and instead we've closed weak. So I think Apple makes much more sense to trade in the downward direction for those reasons. We'll keep an open mind if it compresses and then maybe squeezes, but I would really want to see the higher low over 184 at this point based on the failure on Friday morning. Moving along to Microsoft, what do we see here on the hourly time frame chart? Still, keep this one simple, no need to overcomplicate it. You've got yourself a balance range. It's either a break and higher low over 410 to close the gap, target is 414.70, or break down lower high below the bottom of a now 3-day balance range, breaking down underneath this as a very structurally important level as well. Under 402.75, the door is open for some thin structure to retrace, building on the momentum from the FOMC breakdown in earnings, which ironically was very similar back there, right? Your target would be at 393.75. If you take a look at the daily time frame chart, it starts to suggest perhaps a bit of a topping pattern here with a head and shoulders breakdown through that neckline. Once again, the number is 402.75, and you're looking for a stronger move in the downward direction. Next up, we've got GOOGL. We're still on the daily time frame chart. What do we see here? On Thursday, certainly an attempt from the buyers to support off of the upward sloping 50 SMA, and then on Friday, unwound it right back down to the downside. So, of course, some of the competition news coming out of OpenAI and their search engine. OpenAI's very cool model that was released on, maybe Thursday as well. Sora, the video AI. Pretty cool stuff. So, in the race to AI, Google is maybe feeling some pressure from that point of view. That's the fundamental catalyst, but technically here, right, you're just offering a big lower high from here to here. You are underneath where you really wanted to see buyers step up and maintain price activity above. And this lower consolidation, to me, again, more so like Apple, would suggest that the equal low is the target over time here at 135.75. So bears really took back control on Friday, closing underneath that 50 SMA. If we take a look at the hourly time frame chart, you can see all of the consolidation into the afternoon was at the lows of the overall session. So continued lower highs beneath, looking for breakdown. If it is going to reverse, maybe there's inverted head and shoulders here, and the target would be the reattempt of 144. But even when we get there, I would look for the full gap close. Technically, there's a little bit of a gap in here. Looking for the full gap close and then just daily lower high up against 144, right? Highs, lower highs, and lower highs on the retest of this level right here. So 144, watching that as a key zone. Next up, Amazon. What's going on with Nancy? Just like Microsoft, keep it simple. You've got your balance range happening here. Higher lows over 170.25, target the top end of the range. Lower highs below and in the gap from earnings. 167.35. That's where your bears really start to build more of an edge. So keep this one simple. Nothing to really write home about in terms of pattern or structure. Same thing with NVIDIA, honestly. Now, of course, we need to be very mindful of Wednesday after the close. The implied volatility on the options chain has already been through the roof, but it's going to get even more detrimental if you're a short-term options trader and implied volatility starts to move in the downward direction, right? It's going to be very difficult to make the move really count on the options contract. So I'd love to say keep it simple and just watch for your over or under, but earnings are really going to throw a wrench in the mix here. I would be very mindful of just sort of reacting once the news is out. We're not in the business of playing a 50-50 50-50 coin toss here with two things working against you. So 50-50 in terms of whether or not the market likes the reaction, right? We could beat the numbers, beat the estimates, but expectations could have been higher, right? Or maybe they guide forward in the downward direction. So it's really not about just as simple as black and white, did we beat the expectations or not? It's all about the market's perception there. So it's a 50-50 coin toss. You have theta, time decay, working against you, and implied volatility is likely going to collapse once the earnings report is ultimately out. So I don't know about you, it's just not, it's not an environment for success. If you want to take a stab at it, I, again, always advise, scratch the itch, that's fine, but only using size that you're comfortable with losing 100% of the position. So do what you will with NVIDIA. I'd love to say keep it simple, but unfortunately, earnings, again, throw a wrench in the mix. Next up, let's move along to Metaverse. What's going on over here? You can feel that tension in the air. You can see it on Meta, just, unsure of whether or not it wanted to break and stay above this level, the top of the range, right? Top. It just consolidating, really building into a wedge here, compressing in terms of the range. So one step at a time. I really think that you need to see a resolution with a higher low over 482, or it's a move back down underneath with a lower high 466. One of those two things is the better trade here out of Meta, especially on the heels of Friday's just total chop, to be honest with you. Next up is Tesla. What's going on with Tessie? Finally starting to perform, right? We had talked about the inverted head and shoulders, right? There it was. And on Friday, beautiful hold over the top of many higher low zones on the Thursday breakout. So Thursday's first higher low was over the neckline. The second higher low was over the neckline. And you can see on Friday, we respected the upper of those portions at 198.25. So this is nothing more than just hourly bull pennant looking for follow through to close the gap all the way overhead at possibly 206. If the market's going to go to hell in a handbasket on NVIDIA earnings, I would only be more so concerned out of Tesla if it produces a lower high back down underneath the neckline of this entire pattern at 193. So for that reason, you could probably imagine that this is a stronger possibility, and I would be looking out for higher low buying opportunities above 193, especially if it's just kind of like a muted reaction to NVIDIA earnings. It's like they're good, they're not blowout numbers, but they're certainly not bad. And the market's just like, okay, I guess we can kind of just continue to justify these higher prices. Maybe Tesla, not that it's even remotely involved with NVIDIA, right? But just in terms of the tech space, the Magnificent Seven, this higher low here just makes a lot of sense. If everything continues to be bullish, mild pullback, correct some of this overblown move to the upside, find buyers at previous resistance, turn it into newfound support. That would be a bullish sequence. Let's finish it up with Netflix, larger pullback unfolding on Friday. So you do have yourself an hourly lower high happening here, maybe an H pattern, but you're still above the top of the earnings range. So as long as we're over 579.20, not the end of the world. You're really looking for this to turn into a balance and then break and continue in the upward direction. Remember that the target to the upside is much larger, 616. So watching, like, an ideal situation here might be that this turns into a double bottom, right? You break that neckline, the lower high of the afternoon move from Friday, you trade to Friday's open, and then from there, you're off to the races at 616. Larger issues emerge when and if maybe we get something that does this. Lower high underneath 579.20 would have me feeling a little bit more concerned, but we would watch for what's the reaction at 569. Remember, we already got it on the Wednesday session when we moved back in the upward direction, a little pullback here. But if you were to get a stronger daily higher low at this point now, because you're coming from here to here, that's definitely a daily higher high. Looking for a daily higher low, this would not be unreasonable. Of course, you would be in an hourly downtrend at that point, so that would be a firm higher low at 569. That's it. We've made it to the home stretch. 3.5 trade ideas for you, and then you are on your way. MRVL is up first on the chopping block. Keep in mind that these guys are related to the semiconductor space, so they will respond to NVIDIA earnings after the close on Wednesday. Be mindful of that. But the idea is, can we turn these folks into overhead supply? Will this ultimately yield a lower high double top? You can see in these upper wicks, sellers are starting to step up, and if we break the neckline, which is here at 65.90, we are looking for a move in the downward direction towards the retest of this breakout level from a weekly or even monthly point of view. At that time, you can see prior resistance offered support in the lower wick of that hammer candle, and that target would be at 61.90. Once again, keep in mind, NVIDIA earnings will impact this one, but earnings for the company itself are much further out in the March timeframe. Not interested if we're just chopping around inside the midpoint of this range. Remember, do not diddle in the middle. That is a rule. Next up is UPS. What's going on with the parcel service? Let's take a look. This is a repeat trade idea, but it's even better now, I would say. Like, we were looking for a cup and handle, and now you've got a fake break of this as a very tight consolidation range. We're back into and above the top of that range. If the nature of the market rally is going to broaden out, we're looking for continuation in to close this gap overhead from the earnings gap down. that would be over 149.50, closes up at 156.35. So this is back on the radar after this fake break over here. It's certainly offering a higher low. We've got equal highs. Can the gap close overhead is the name of the game. Then the 3.5 component. What the heck does that mean, Matt? Well, first and foremost, let's go back to JP Morgan. And this was a trade idea from last week. We were looking at this flat top breaking out. Beautiful day on the Thursday session. Now it's offering a 3-bar play for continuation. Up and over 180, we've got blue sky territories. Bring it on home. We also know that financials, as a general idea and a part of the thesis for the S&P 500, is that if that can continue in the upward direction, again, that speaks magnitudes about the bullish nature of the S&P 500. So if you're looking for a trade idea in that sector, JP Morgan can see continuation, and 3.5, because it's very similar and in the same vein, is Wells Fargo. This is at a cheaper price point, and you could probably just use shares on this one, to be honest with you. Plenty of liquidity here, but look at the 3-bar play, bullish inside bar in the upper third of the Thursday range, staying over the previous resistance highs from over here. If we get that breakout, there's a nice little trade that could unfold here into 54, which is much more of a weekly target, right? If you look back here, prior rejections from this weekly chart ahead of the breakdown in 2022. You're also getting a weekly bull flag breakout from this point of view, which makes sense based on small caps, right? So there you go. The trade idea is tying directly into the main thesis of today's video here, and that's going to do it for today's episode of the Weekly Watchlist. I truly hope you enjoy your long weekend. We will be back up in the penthouse on the Tuesday morning session for the pre-market prep starting at 8:15, free as always here on the YouTube channel. With that said, have a green trading week, and I will see you in the next one.